This week, we're talking all about the new capital gains, and we are joined by Matthew Farronato from Investors Group to talk all about it. But before I jump into that, my name is Justin Little. I'm a local real estate agent here in Hamilton, Ontario, and I love making educational videos about the market. So if you haven't already, be sure to subscribe and join the growing community. Matt, thank you so much for joining me today. I really appreciate it.
Yeah, thanks, Justin. Thanks for having me.
Yeah, we were talking about this over lunch, the new capital gains. And I mean, I try to stay up to date with this stuff, but obviously you're more in the industry in that side of it. So it was really eye opening when we were kind of going through the examples and what it means. But can you go ahead and just kind of explain what the new capital gains ruling is?
Yeah, absolutely. I've been fielding a lot of questions about this. So, if you read the budget that came out recently, the proposed changes around capital gains tax and specifically the inclusion rate. So, whenever you sell a capital property, an asset, or within a corporation, you sell shares, you trigger what's called a capital gain, a tax implication. And the proposal is changing the inclusion rate from 50% to two-thirds or 66.7%. So, where I think this will be most impacted is in the personal side, at least for secondary properties, cottages, rental properties, anything like that. I think people got to be mindful now of what that upcoming tax implication is when they decide to sell. And there's really a few different pieces going on. We've had such a hot market that it's really not unrealistic to see a capital gain over $250,000.
Mhm.
And that's where I think some tax planning and just some general financial planning and working with your accountants can really help you figure out what strategies are right for you and really just know what that tax implication is going to be. I think just a simple example, really, is let's say the family cottage. We see a lot of people that maybe over the past 5 years bought a family cottage, or maybe you've owned it for a lot of years, and then you really probably have a large gain on that property. And I'll use a simple example. Let's say you bought the cottage 10 years ago, $500,000. Today, it's worth $1 million. So if you own that jointly, so let's say mom and pop own the family cottage, if they were to sell that cottage for $1 million, the capital gains $500,000 because it's joint ownership. They're each responsible for 50% of that gain. So mom has a $250,000 capital gain, dad has a $250,000 capital gain. They're still within that $250,000 threshold. So the inclusion rate is still only 50%. Now, where this would get tricky is let's say mom and dad want this cottage to stay in the family and just continue down to the next generation. Well, let's say dad passes away, mom takes full ownership of the cottage and now tries to leave it to her kids through the estate. Now, mom's capital gain is $500,000. So instead of just having the original 250,000 at that 50% inclusion rate, now she's going to have 250,000 at the initial 50,000 or 50%, and the second 250,000 is going to be at that new rate of 66.7% or two
Wow.
thirds. So it makes a huge difference. Just in rough math, she'll owe roughly between $20,000 and $30,000 more in taxes on
Mhm.
that same disposition. So where I see a lot of planning opportunity, let's say, is being preemptive about what mom and pop can do about the cottage. There's no gift tax in Canada, so that brings about a good opportunity to dispose of, let's say, the cottage before anything happens to either of them. So you could gift it to your children, still considered a deemed disposition, but at least this way they're triggering the tax in a way that's more favorable to them rather than it going to the estate. Um, you can use things like permanent life insurance to mitigate the tax implication. It'll be an efficiency, still has a cost to it. And then lastly, outside of, let's say, the capital property side, at least on the investment side, if you have a large portfolio, of investments and you have a large gain, you can be mindful of triggering those gains over successive years in smaller increments rather than triggering all at once and incurring that higher tax rate.
Mm-hmm.
Um, Unfortunately, in the corporate space, the inclusion rate doesn't start at above $250,000. So, right from the get go, any capital gains that are triggered within a corporation are going to start at that two-thirds rate or the
Wow.
66.7% inclusion rate. Um, so really makes it difficult within that, call it small business world or self-employment world where you are incorporated. I know real estate agents are in that bubble. You might hear a lot of talk right now about doctors
Mm-hmm.
because it's very common for doctors to have a medical a professional corporation where they accumulate, let's say, their retirement or their nest egg, and uh, knowing that they have that looming tax bill coming when they do want to retire or dispose of those assets to produce retirement income, um, it's going to present some challenges for them. Um, you have until essentially June 25th until this comes into effect. We're unsure if it will stay as is or if it'll be challenged. And with anything, I think it you never know if down the road another government changes the rules again. We had
Mm-hmm.
a higher rate back in the day, and this won't be the first time that a proposed change has been made. So I think it's important just to kind of talk to your financial planner, talk to your accountants, understand the tax implications, and see what you can do about it. I don't implore anyone to go start triggering capital gains before June 25th and just trying to sell off property to get ahead of it. There's also another change in the or proposed change in the tax law with the AMT rules. We're at a higher rate, so you don't want to be triggering AMT, which is alternative minimum tax amount, and think you're beating the capital gains tax, but instead paying a different type of tax.
Mm-hmm.
Um, you really just want to be mindful of how you go about disposing of these assets because I think like you see, Justin, it's been very common to for anyone to buy a secondary property, whether it's income or
Mm-hmm.
cottage or like. Um, it's very popular and in vogue over the last, let's call it 5 to 10 years.
Yeah.
And with the real estate market being so hot in Canada, it's pretty common to see these large capital gains.
Yeah.
Um, I'm sure you
It's
run into it all the time.
We are, and it's kind of split where you do have some investors that were just doing the quick turnarounds where they made 50, 100K. And I guess they wouldn't necessarily be affected by it, but those days aren't around anymore where you can get that quick 100K. Like now it's still a longer term process. But I was just thinking as you were talking about it, how funny it is. Like, everybody got into investment properties. It was very popular because the rates were low. Now the government's raised the rates. So a lot of these investment properties aren't even cash flowing, so a lot of people are forced
Yeah.
to sell. So now the government's going to tax them a higher rate to sell it. Like it's funny to me. But the so you're saying don't rush to sell before June 25th. Don't go out there and do it,
No, I
or
consult your accountant, consult your financial planner. I think it, it's tough to try to make these quick decisions to get ahead of things. 4 years down the road, we might be in a whole new set of rules. So I think just being mindful of what you're getting into, because at the end of the day, you're trying to make an investment, and
yeah.
you want to keep as much of that profit in your pocket. So just understanding how and what to do to tackle it is important. It may make sense in certain situations to unload some properties, but I would say consult your
Mm-hmm.
experts before you rush to market. I'm sure even you see the cottage market isn't quite what it was either. So if you start to see a lot of properties flooding the cottage market, the difference in let's say fair market value or the price you'll get for that cottage might eat into your lunch more than the tax would anyways.
Yeah, it's true. Especially cottages has slowed down quite a bit. Because everybody went nuts buying cottages during COVID with the idea that we're never going to be able to leave Canada again, or at least for like 5 years. Like nobody knew, right? So everybody was like, "Oh, I'm going
Yeah.
to buy a cottage property," but now we are starting to see a lot of them come to market. A lot of areas have even put bans on short-term rentals, which affects Airbnb revenues. So a lot of people that were relying on that can no longer rely on that. So we are seeing them come up, and it is a crawling market, right? Like I know Muskoka is our cottage area, which is like Selkirk, Port Dover, those kind of areas. They're very slow as well. They're essentially buyers markets, and there's some really nice properties up there because I'm always a dreamer. I'll look at the cottages that are listed and think, oh yeah, this is nice, right? Maybe one day.
Yeah.
But they are sitting for a long time. So, but the tax, when you pointed out that it's going to be more on the corporate side, 2/3 right off the bat, there's no, so for personal, the first 250 is taxed at 50%, and then anything
Yep.
above is the 2/3, right? But corporate's 2/3 the
That's
whole way. I feel like you're
yeah.
gonna have people on both sides of the fence there. You're gonna have the people that are anti corporations buying property because they feel like it drives the prices up, right? So some people might think, oh great, this is gonna stop people, which it might, because at the end of the day, it's cutting into the profit significantly. But then you're also going to have the people that own these properties, the corporations that are going to say, "Man, why am I getting killed here?" Right? Like we're
Right.
providing rental
Yeah.
opportunities for people, and they're killing me now that I want to
Yeah.
sell it. This was my retirement.
A lot of people, so it's very commonplace to see business owners owning the buildings that they operate in. So whether it's a dental practice, a medical practice, an engineering firm, it's so commonplace to see these companies own the building because it's an efficiency. Then they don't pay a huge exorbitant amount for rent. um, and so knowing that obviously these companies and these professionals want to operate long term, it's their career. um, there's that looming tax bill with the sale of shares of the actual business of um, the owner's shares. There's what's called the lifetime capital gains exemption. So they did increase that. That's one, I guess, silver lining, if you will. So that currently sits at 1.25 million, or the proposal is, um, which will aid in some of the disposition. But any of those capital properties, any investment portfolios built within corporations, that's really what they're targeting.
Okay, and then do you think that it's like, I don't know, what do you think about the hike? What was the plan around this? Do you have any insight to what do you think the thought process was to raise it?
Yeah, I think at least from the rhetoric, it's trying to grow the tax base. So they're looking at what they call the 0.1% wealthiest Canadians. Um, I kind of laugh because at the end of the day, I don't think every family that owns a second property is in that bubble or in that classification of being the super wealthy. So I think the trickle down effect will have maybe more of an impact to those families or those people that are just
Hmm.
trying to build a nest egg and trying to build a retirement for themselves. Um, we already pay pretty high rates in Canada for tax purposes, let's say, and I think at the end of the day, it's one of those things where we need taxes to fund our government, our economies. Um, you just don't want to be on the other side of that coin. I don't
Yeah.
think anybody enjoys getting that bill. But at the end of the day, I think it's something that's happened in the past, just depending on what government's in favor. And I think it'll probably change a few times over in the future again.
Yeah, let's hope so. I'm hoping by the time I go to sell my the investments there quite a bit less because you're right. It's not ultra wealthy. I'd say majority of my clients that are investors that own investment properties, probably 90 to 95%, they own maybe just one investment property. And for them, it's because they don't have a pension lined up. They don't have any sort
Yep.
of retirement lined up for themselves. So this is their way of getting that retirement, right? It's one avenue. So you're right. I do think for the small investor, it's really gonna, and for the large investor, I don't even really see it being a huge deterrent because at the end of the day, they just chalk it up to this is the cost of doing business. They look at it that way, right? Okay, this is what I'm paying now. It is what it is. I don't think it would really deter those larger investors from doing anything. If anything, they might hold property longer to wait for this to come down. So if any, yeah, I guess it could actually produce less inventory on the market than more. If I
Yeah,
was
I
thinking of
think you
selling,
naturally
I'd be waiting.
yeah, and I think that's exactly what's going to happen. I think you're going to see people kind of start to hold on to property and maybe get away from that quick turnaround mindset that we've been seeing a lot in the market. And I guess that was a product of opportunity. But I just the wealthy tend to understand how to put strategies in place to maximize their return.
Mhm.
And I think they usually have a lot of moving parts, so it gives rise to more creative planning. Where I think, like I said, I think it's really that family cottage um, that's really going to get really hurt in this type of move and taxation. It's good intentions, and I think at the end of the day, no one wants to see their tax rate go up by almost 20%.
Yeah, that's wild. Well, whatever. It is what it is. We're here now, so we got to deal with it, right? But I appreciate you shedding light on that. That's coming on and doing it.
Thanks.
Yeah, I wanted to make a video about it, but then I was like, you know what? There's just so much here. I'm going to bring in a professional to make sure that everybody's getting the right information.
There's a lot of questions, and I think there'll probably be a lot more questions. And I think maybe after June 25th, we'll have just a little bit more clarity on how and what shape this is going to come out and be put into law. Let's say.
Cool. And then if somebody wants to get a hold of you because they want to talk more about this or talk about planning for it, what's the best way for somebody to get a hold of you? I'll put your information in the description below, but what's the
Yeah,
best avenue?
yeah. Shoot me an email. We can put my email in the comments below, and just send me your questions. I'm happy to help out.
Perfect. Awesome. Thanks, Matt. I appreciate it.
Thanks, Justin.
All right, we'll talk to you later. And thank you everybody for joining us this week. It's a pleasure to have you tuning in, and I look forward to talking to you again next week.